Morena, everybody. Welcome to the launch of the Aotearoa New Zealand 2024 Responsible Investment Benchmark Report. Inga mana, inga reo, inga iwi, inga hoewha, ina tātou katoa. Ko Dean Higati taku ingoa, no whakutua ahau, he papa ahau, ko te whānau taku tuatahi, ki tauira ahau I te ao Māori, engari mamihi ka tika, ki ngā tangata whenua o tēnei rohi. Ngā ke ngui anō, ki tēnei mahi, ki tēnei kaupapa, tēnā tātou katoa. My name's Dean Higati, I'm the co-CEO of RIAA. I'd like to first acknowledge the traditional custodians of the land that I'm on, Ngāti Whatua, up in Tamaki Makaurau, Auckland, and extend that acknowledgement to all the different lands that people are joining us on today. The reason we are here is that we are today launching for the 20th time a foundational piece of research which measures and maps the size and growth and the trends in the performance of the responsible investment sector. This is the 20th year that we've published a report that specifically profiles the New Zealand RI market, and it's research that draws on responses and analysis from 50 New Zealand-based fund managers, as well as an additional 20 who are based outside New Zealand but are managing capital here. It's also part of broader research that RIAA does, where we analyse over 340 fund managers who are operating across Australia and New Zealand. The reason why research like this is so critical is that we can all see the changes happening in this market, and at a top line level, it's actually really easy to see the direction of travel and the momentum that has been created. We are, everywhere we look, seeing more money is being managed more responsibly. But what reports like this allow us to do is to really tangibly measure and understand the details so that we can understand where those investments are going, what's driving some of the decisions, and hopefully provide some breadcrumbs to help us understand what's going to happen next. So we'll launch into the survey results very shortly, but first some thank yous. This really is a massive piece of mahi that relies on a wide range of contributors. Our research provider, EY, have been a long-time partner with us on this report. Again, who've lent their expertise to help bring together the findings. We have our industry partner, PIMCO Asset Management, who likewise have been supporting this research for a long time as partners. And their support on this research really does allow us to dedicate the resources that we need to pull this work together. The other big one, though, is all of the RIAA members and those who provide us their support, but in particular, both members and those within the wider industry who provide us with the findings by taking the time to contribute the data that we need. There is no shortage of requirements for data upload and reporting at this point in time, and we really appreciate you taking the time to help us bring this kind of research to market. So what we'll do today, we're going to run through some of the key results. My colleague, Head of Policy and Advocacy at RIAA, Nanisha Samarakun. Then we'll move to a panel discussion. We're going to unpack the results, really dive into what they mean, how these findings can provide a really critical reference point to where we are, but also, as I say, hopefully a pathway to where we are going. There is Q&A that's going to be available. If you have questions as we go, feel free to put those in. We'll come to those once the discussion with the panelists starts. But firstly, please welcome Nanisha.
Thank you, Dean. Hi, everyone, and thanks for joining us for this launch. I also wanted to echo my thanks to our research partner, EY, who does a lot of the heavy lifting with this work. I also want to thank RIAA's research manager, Balkan Dandabanjic, who has been instrumental in pulling this together. So thank you so much, as well as our sponsors and panelists today. So moving on to, I'm going to set a little bit of the scene before we get into the nitty-gritty of the data. 2023 was a really big year for a lot of policy development and regulatory development globally, as well as in New Zealand, really focused around disclosure, reporting, and taxonomies. You'll see that the EU continues its strong position as being a leader in terms of a lot of this policy. And what we really saw in 2023 was that expansion from climate to other sustainability areas, with the EU taxonomy expanding into nature and biodiversity, as well as the introduction of CSDDD, the Corporate Sustainability Due Diligence Directive, and the movement into not just reporting and disclosure, but also actual conduct and rectifying and mitigating that conduct. We also saw that a lot of policy progress was made in Asia, with significant advancements in Japan, Hong Kong, Singapore, and China, and as well as the TNFD, which was a major launch at towards the end of the year. As you probably know, RIAA is a convener of the TNFD, the regional convener for the policy working group. So to have that launch with its final recommendations after some time was really a welcome development. On to New Zealand. As you can see, this was the first year, and I imagine a lot of you will remember this time. So it was the first year that the CRD regime commenced. We saw a lot of guidance from both the External Reporting Board and the Financial Markets Authority in relation to how best to report, in particular for XRB, we saw with the ISSB finalising its sustainability standards, guidance around the alignment of the CRD to the ISSB reporting standards. So I think it's really that kicking off of the CRD regime, which will have impacts into 2024 and also going forward. And I know we'll talk a little bit about that during the panel discussion as well today. I wanted to point out in particular the government moves are in 2023. We had the first Australia-New Zealand 2+2 climate finance dialogue. This was the meeting of both countries' finance ministers and climate change ministers to really discuss how to address the climate change risk, but also how to harness opportunities, recognising the close ties between the two markets. I wanted to also call out that it was the first anniversary of the Stewardship Code in New Zealand, of which RIAA also co-chairs. And we saw that within that first anniversary, we saw 60% of the AUM of New Zealand sign up to the Stewardship Code, which when we get to stewardship, you'll see has had an impact on disclosure and transparency. One of the big, so I mentioned the Australasian launch. We also had really important competition guidance coming out from the Commerce Commission around collaborating on sustainability goals. I think that has had a significant impact within the market and really reflects the ongoing complexities of some of these discussions, where it's really difficult to address sustainability impact without discussing with other market participants. However, the additional policy risks that might provide. So that guidance was very much a welcome development. Obviously, one of the impacts that continue to have that will continue to be an impact will be the election and the new New Zealand government. That brought on towards the end of 2023 policy uncertainty, both through the course of forming government, forming a minority government, as well as the three parties messaging around sustainability. So we know that the New Zealand government continues to provide a high level commitment to net zero. However, particularly in 2023, the 100-day plan that was launched in November really demonstrated there was a change in a number of those climate and sustainability policies. So just leading to that a degree of policy uncertainty towards the end of the year. So with that setting set, I wanted to talk about our research. What we have is a growth in our responsible investment AUM. This is really around the research universe, which is comprised of everyone in the total managed funds of New Zealand who self-declares as practicing responsible investment. Within that group, we have the New Zealand Research Group, which is the 50 that are headquartered in New Zealand, the 20 that are based outside of New Zealand, and also which encapsulate the research universe, which has grown to 294 billion New Zealand dollars. And within that, the impact of responsible investing, our leaders and those who are really performing at a high level has grown to 207 billion. So that the growth is really an indication of where the market is going, as well as the proportion of research universe and responsible investment AUM growing demonstrates that this is really around part of effectively being mainstreamed into investment in New Zealand. The next slide talks about this a little bit more. You can see that the AUM of investment managers that are in the research universe grew to 13%, as well as more than half of those managed funds are now invested responsibly. So that really shows the proportion against the total managed funds in New Zealand, and also the amount that the responsible investment AUM setting a new record this year at 207 billion. I mentioned before the stewardship code in New Zealand, really demonstrating increased transparency. Next slide, please. Thank you. Showing that we're seeing it's also having a stewardship code. It's not only about the specifics, it is about that general encouragement of transparency within the market. And we're seeing more than ever full fund holdings disclosure being a part of responsible investing, and the proportion of managers who only provide partial disclosure is really dropping. And we've got a growth between 2022 and 2023 of 4 percentage points to 77%. I might mention here as well that one of the other aspects we look at is public disclosure of ESG policies. And we see that that has grown from 81% in 2022 to 90% in 2023, really demonstrating that this is not only about doing responsible investing, but also being out there and being seen to do a good job within the market as well. On to responsible leaders and investors. As you know, we announced this earlier in October. We can see here, we continue to measure against the 4 pillars. And we see here that the difference continues to be around pillars 3 and 4 between non-leaders and those who are responsible investors and responsible investment leaders, particularly around stewardship, pillar 3. It's not only is it a key differentiator between non-leaders and then the responsible investors and leaders, but it is also a differentiator between responsible investors and responsible investment leaders, demonstrating that, you know, to be the leader in responsible investment, it is not only about a commitment, it's not only about an internal process and integrating ESG within your general investment practices, but it is also about the focus on positive outcomes and the influence and drive that you have within the financial market. For the lowest scoring for non-leaders continues to be pillar 4, around allocating capital to target specific outcomes. And we see this is all, what this indicates as well is the need to really actively engage with those outcomes and to demonstrate leading practice through influence, not just the, I guess, the promotion or the commitment. I wanted to also talk about performance of RI. So since last year, because of the growth of the RIAA certification program, we really look at the performance of the RIAA certified products, thanks to Plan for Life actuaries and researchers who analyse the RIAA certified products against a general benchmark of the market. And what we see here is that following a fall in 2022, reflecting the general market movements, we see a strong recovery as well as medium to long-term performance above and beyond the benchmark. This is also reflective of the general nature of RI, demonstrating that there are short-term fluctuations, such as due to increases in 2022, which saw both mining and resources, and particularly mining and resources, grow in value over that year, having an impact on RI. However, what we see is that over the long term, we have responsible investment products outperforming the general benchmark, which is really great to see. This is also reflective of both overseas funds as well as within this region, and I think, yeah, demonstrating sort of that importance of performance for RI as well, and that movement away from this conversation of performance versus values, and demonstrating that strong growth. Next slide, please. Thank you. So to really get into the detail of the findings this year, so this is the first year that the survey used the new updated global definitions of RI approaches. RIAA is one of the founding members of the Global Sustainable Investment Alliance, and along with CFA and the UN Principles of Responsible Investments, publish these new global definitions to really reflect the development, and also to answer a call from regulators for industry to come up with some of these terms and definitions, and to attempt to standardize as much as possible. These have been reflected in our updated responsible investment spectrum, which are probably all across, as well as the report this year. And we've got the 7 approaches on the side. So looking to the first one around more generally the approaches, next slide, thank you. We see that the AUM allocated to each approach has increased significantly. And this is not just about ESG integration and screening. Stewardship is also up there, demonstrating that it's through these 3 approaches that we have the sophisticated RI approaches throughout the market. It's worth noting that they're not necessarily exclusive, so it's not a matter of stewardship or norms-based screening. There is a lot of this is around the importance of allocating money to the relevant outcomes that you're really looking to provide. I wanted to notice that this data includes information from Kanga News, but also that the methodology that Dean talked about in terms of desktop research and survey, there is always a variance between whether an organisation was assessed by desktop one year and also by survey the other year. So in terms of that comparison, this is a methodology, it's part of the methodology, and is something that we manage. And because of the size of the New Zealand market and the makeup of the New Zealand market, this is an aspect that really does play out. So moving into the first of the specific approaches, ESG integration, we see here that has been continues to be a very high allocation in ESG integration. As I mentioned, this is effectively now mainstreamed into general investment risk and risk mitigation and assessment, as well as being adopted in 2023 by 96% of our survey respondents. Out of this, 74% apply fund-wide and 22% incorporated at the product level. You'll see that those who don't apply ESG integration at all has decreased from 21% down to just 9% in 2023. As well, in the New Zealand research group, so those who are headquartered in New Zealand, 65% of asset managers now have dedicated ESG staff or responsible investment teams, really demonstrating that commitment to managing ESG risk and embedding it within the organisation, as well as, and I imagine that has a lot to do with some of the policy outcomes that have occurred as well. Next slide. Thank you. Negative screening remains one of the most popular types of screening, well, remains the most popular type of screening. This is around where rules are applied on undesirable sustainability criteria, determine whether that investment is permitted or not permitted. In 2023, 96% of survey respondents applied negative screening to $201 billion of their AUM. You'll see that that is a significant increase from 48 to 201. In terms of what they're actually excluding, tobacco remains number one, as well as nuclear weapons, controversial weapons. And we've had a drop in fossil fuel exploration, mining and production as well, again, through different allocations within some organisations between 2022 and 2023. As mentioned, so one of the things that we do in the benchmark report is leverage the work that we do in the consumer report. So there was a consumer report released in partnership with Mindful Money this year to evaluate New Zealanders' sentiments around responsible investing. In the benchmark report, what we try to do is look at what sectors do investment managers exclude, and then how does that compare to those issues that New Zealanders are looking to avoid when they invest. There is welcome alignment on the top issues that both institutional investors and New Zealanders look to avoid when investing around tobacco production, weapons, and gambling. And this is closely aligned, which is really great to see. That's not to say that there are not opportunities, particularly around animal testing and environmental degradation as well. Moving on to norms-based screening. So this is really around rules that rely on investment managers complying with widely recognised standards or norms, which then determine whether an investment is permitted. This screening style approach has continued to grow in popularity, with assets under management increasing from 2022 to 2023 to 183 billion New Zealand dollars. In 2023, 65% of managers incorporated this approach into their strategies, and the majority of those did apply that fund-wide. And you can see there the most popular conventions are around the UN Global Compact, as well as the Convention on Cluster Munitions. A Paris Agreement was also applied by 26% of respondents, maintaining the same level as last year. Moving into positive screening, this really relates to making an active choice around what you include because of desirable characteristics. And the money flowing into positive screening has increased around from 13 billion in 2022 to 41 billion in 2023. Most of the respondents applied it at the product level, which is something that we do tend to see, as well as most of those asset managers applying it in relation to renewable energy and around climate change and sustainable companies, which is a really interesting point around the more sustainable companies, demonstrating that there is value for being seen to be more sustainable at the asset level and being an ESG leader or best of sector, as well as demonstrating that integration and governance within the corporate sector. So moving on to thematic investing. This really relates to the degree to which a specific theme is targeted by the investment manager through the strategy. And we're seeing here that 57% of respondents use this mostly at the product level, And the majority of the, and this is also another one that is compared to our consumer research in relation to those themes and issues that New Zealanders care about when they invest. And we see that there is alignment around healthcare and medical products, as well as climate change. But then there are also opportunities around sustainable water, healthy rivers, that blue economy as well. What is worth noting here is that these themes do overlap, but also has a lot to do with that policy and regulatory framework as well as what's sort of front of mind, particularly for the consumers. Moving on to stewardship. So we've had an increase in 2023 in terms of stewardship reporting from 40% to 51%. It's worth noting that the stewardship code, the New Zealand stewardship code's first reporting year was this year. So it'll be really interesting to see how that has an impact on the market. The number of investors who are either only reporting on one activities or outcomes, one or the other, has decreased to 13%. And we're seeing sort of that more detailed reporting come through in the majority, just over half of the market. In terms of the issues that stewards are engaging with on investee companies, climate change remains the top one. What's really interesting is that diversity and inclusion is second, and then human rights, including modern slavery. One of the aspects of 2023 was the government's commitment to introduce a law to tackle modern slavery in New Zealand, and we know that that has been pulled back. So it's really interesting to see that there was in 2023 active engagement on human rights and modern slavery, and I know that that remains very much a critical issue for New Zealand investors. Biodiversity Nature Convention remains in the top 4 as well, and really demonstrate that this is not just about climate. It's also not just about nature and climate. It is also around those social factors as well that investors are really doing the most on. On stewardship, voting is one of the key tools that investment managers have to influence that corporate behaviour. What we saw was that in 2023, the majority of asset managers in that New Zealand group are at 60% demonstrate their stewardship and active ownership through voting. And this voting is across all possible holdings. And there's a smaller proportion at 4% who reported voting only across where their funds are materially exposed. And what was interesting with this data was that 26% of asset managers were unsure about their organisation's approach to voting and stewardship, which really indicates the potential gaps in awareness around the proxy voting strategies in New Zealand. And then impact investing. So total impact investment had a great increase to $15 billion from 11. The majority of this is carry bonds, green, social, sustainable, or climate bonds. However, what was really interesting was that the impact funds increased from around $1 billion in 2022 to 5.28 in 2023, which is great to see that move, not just in the debt market, but also within the impact fund market. That impact investment strategies are being employed primarily around climate-related initiatives, which aligns with that broader sustainability, climate-focused movement. But as well, there are social themes around affordable quality housing, racial equity, financial inclusions, which are also seeing impact investors take an active approach. And on the bonds, we can see that there is remains a a real growth in impact-specific bonds as well. So that vitalisation of the debt market. Worth mentioning for impact investment that for our survey respondents, one of the aspects that we ask is around the outcomes that have been achieved, and you'll see in the report this year, there's been a number of quantifiable outcomes around 1.4 billion cubic metres of water saved, 30 million student and early learning placements, and 669 million tonnes of carbon emissions mitigated. So it's really great to see that measurable outcome and that investment strategy that allows for that measurement as well. Great. So as you know, we launched our leaders at the start of around mid-October, and a really big congratulations again to the New Zealand Responsible Investment Leaders and the New Zealand Responsible Investors. It's great to see that we had a 66% growth in improvement in scores between 2022 and 2023. So thank you again for engaging with responsible investment, and as well continue to improve your practices. I'm going to hand back to Dean for the panel discussion. So thank you.
Golda, thank you very much for that, Naomisha, and certainly leaves us with plenty to unpack. So in terms of the report, you'll all have a full link to it in your inbox after the event. Please do make sure you download it and go through it thoroughly to understand all the different kind of dynamics that are at play. Before I introduce the panelists, again, just a quick reminder, we've already had one question come into the Q&A, so that function is there. If there are questions that you'd like us to focus on, please do let us know via that function. Now I'd like to introduce our guests for the kōrero on key findings. So firstly, based in Auckland, I'd like to welcome Frances Sweetman, who many of you will know. She's the Head of Sustainability at Milford Asset Management. Milford are one of the leaders who are identified in the report, as well as having certification and fund certification as part of their portfolio. And also joining us from the US is Erica Kinsella. She is the Senior Vice President and ESG Strategist at PIMCO, is a returning guest to the RIAA New Zealand Benchmark Report launch. PIMCO, a global fixed income provider who all of you will know, and likewise recently announced as a leader in the Australian report. Kia ora to you both. Just in terms of general overview, interested to know you've been able to look through the report, have a bit more time to digest it. Erica, I might start with you. What was sort of the most interesting thing that jumped out at you?
Yeah, well, thank you, Dean. It's a pleasure to be here, and thank you for having me on today's panel. So, you know, as Naomisha had reviewed, there's a lot of encouraging data in this year's report. I was excited to see the double-digit and record-breaking growth in sustainable AUM, as well as the growth in particular in impact strategies. And I think that another interesting point that I took away was also the diversity and range across the various different responsible investing approaches. This was interesting, and I think it really underscores the current state of the market that we're in a sustainable investing landscape, and also, as mentioned, where we're potentially heading. As a global fixed income asset manager, you know, we are seeing greater divergence than we have seen over the last several years in terms of how investors are approaching sustainable investing, and we, you know, expect that that's likely to continue. We're also navigating a multi-speed world across not just investor preferences, but also policies and regulatory approaches, you know, which Naomisha had also reviewed earlier in the findings. And, you know, we think that it's likely to continue to kind of be divergent and occurring kind of at a multi-speed evolution in different paces in different regions, and that it's unlikely that there will be a convergence going forward. Now, what does that mean for investors in the space? Well, you know, we think that creates, you know, interesting investing opportunities, particularly for active managers in sustainable investing. And at PIMCO, you know, despite the potential divergence ahead, we remain committed to providing the best investment solutions for investors, as well as to help support our clients as they navigate these evolving regulations and reporting requirements looking ahead.
Thank you so much, Erica. Frances, what about you?
For me, Dean, it really was that growth that I wanted to focus on, because we look at the New Zealand fund management market growing 5%, and then the 70 investment managers that you looked at as part of this survey growing AUM 13%, as Erica said. I mean, that is a huge outstripping of growth and taking of share. And across these managers, more AUM has been allocated to all the different responsible investment strategies, from exclusion, engagement, integration, positive impact, which is really exciting. So we're all doing more sustainable investment, and we are all taking share as responsible investing managers. And I think with all the noise that's going on in the world at the moment, that is a really, really encouraging message.
Thank you, Frances. Maybe, given that you both started on growth, I might just kind of dive into that. So one of the things I think that jumped out at me was the motivation, and when we asked asset managers why they thought demand was growing, what was driving that demand, they really highlighted increased performance in the long term, as well as the value of ESG and risk assessments that were really fueling it. And I think that is quite different to what we've maybe historically seen, which is, we've talked a lot in the past about legislation coming down the pipeline and that driving people into this, as well as sort of investor demand. It's really interesting to me that now that risk assessment, and a really high quality risk assessment, as well as performance returns, was highlighted. That mirrors what we've seen in Australia with the Australian report. I guess interested to see, and maybe Frances, start with you. Does that reflect what you've seen and what you see? But secondly, how does it change this industry going forward now that really a lot of this is being ingrained as part of just a high quality investment approach?
Yeah, great question. It is what we're seeing, that more and more explicitly integrating ESG into your investment practices is absolutely standard. It's what every single investment manager should be doing as part of their investment process. We're here to manage risk. This is a huge and growing risk. So, I think that's fantastic. And if anything, I think it should we should be able to continue to demonstrate that this is adding value, because the underlying performance of our investments should continue to bifurcate as climate risk grows. So I think this is only going to improve and continue to increase. But as it is becoming more standard, and as it is becoming more well known as being just an integral part of what we do, hopefully that allows us more headspace, more time, more focus on those other strategies that are going to allow us to actually deliver impact. So that will help the industry grow and mature, and that's what I really hope that we'll see.
Erica, obviously looking with a more global perspective, that also reflects what you've seen, and again, keen to get your thoughts on how you think a shift like that is going to change the industry going forward.
Yeah, so we've also, seen a similar focus around ESG integration. I think from more of a global perspective, investors are really looking for a variety of solutions that ultimately meet their financial objectives. That may include having a sustainable orientation, but in certain markets, that's not really a focus of investors. But, we do see that they're, regardless of what camp and cohort an investor might be in, they are really looking to understand how an asset manager is, identifying risks and making, pretty sound and fiduciary investment decisions. And at PIMCO, we view the integration of ESG risk factors where they're material in an investment process as a way to make better informed views and decisions on a credit borrower's position that ultimately can benefit investment outcomes for investors in sustainable strategies or in traditional strategies. So, we have seen an increased focus, globally around ESG integration into an investment process, but then also, investors are taking a look at the practice and the process in more depth, and how it really differs from investing in a product that has a sustainability orientation that may be more relevant to a traditional portfolio. One of the reasons is an awareness of the potential materiality of these risks, like we just talked about. But another, reason is investors are increasingly focused on greenwashing risks, and the focus on due diligence of integration is one way to better understand an investment process, but also to potentially reduce some of that, greenwashing or regulatory risk, which is, certainly top of mind for investors globally.
And you mentioned greenwashing, and again, I suppose the flip side of the growth discussion is asset managers highlighting that greenwashing had grown significantly to become the largest concern and the largest barrier to them getting into ESG and investing in this way. I guess, without question, a whole lot of changing regulatory environments, a lot of changing expectations amongst investors as well as regulators, and also very conscious that that is changing at different speeds in different ways in different jurisdictions. And so would love, Erica, to maybe get your understanding looking at this across different markets, and you operate in a lot of different markets. How do you manage that kind of risk?
Yeah, so, when we're talking about greenwashing and in certain, markets, we're actually, talking about a potentially new term, which is called green hushing. Regardless, we think that this is where engagement and stewardship, depending on, with asset class you're in, but as a fixed income manager, engagement can really add significant value. So as a bondholder engaging with company management, which is core to our investment approach, it allows us to understand how an issuer is addressing sustainability topics that have the potential to impact, again, our view of that credit and that borrower. Issues that we may engage with relate to, climate-related risks, but as well disclosures. So in markets where there isn't mandatory disclosure requirements, and really where it's up to the issuer to kind of self-disclose in public-related reports or other forums what they're doing from a sustainability perspective, we can really, through our engagements, have one-on-one conversations with company managements to understand more deeply the commitments or the strategies that they have to address ESG risks or advance certain opportunities in their business. So, we think that the engagement work with issuers, in terms of coming to market with sustainable issuance is also an area where we can have potentially more transparency, but also impact. So as a large buyer of instruments like green bonds and sustainability bonds, we're in a position to enable financing toward what we view as ambitious and credible label issuances. So in some ways, to reduce the potential greenwashing risk associated, with issuance coming to market under certain labels that may not be as transparent. So again, another kind of mechanism that we have to address greenwashing or even green hushing risks.
Green hushing, how big of a problem do you see that as being? Do you see a risk that we're simply going to see people just watering down the claims that they're making or the goals that they're setting for themselves?
Well, I think that, again, in markets where there's not, a policy or regulatory, requirement to disclose, some of the activities around, climate or, other sustainable activities, that it's up to the issuer to do so. And in markets without that regulation, we have seen a pretty high volume of self-disclosure and self-reporting. And I think it's hard to think that that is going to completely dissolve or go away. But I think that it's fair that in again, certain regions that you could start to see some of that language shift, or the terminology for how it's being described might change, or maybe the ambition of maybe former commitments may be not as transparent. So again, this is where engagement and having kind of those direct conversations with management teams to really understand at a deeper or under the hood level, are they really taking a step back? Has something really materially shifted in their strategy, or are things still progressing, and it's just a matter of them progressing in maybe a different kind of different way that is maybe slightly different to how the market may perceive it going forward.
And Francis, we're obviously a jurisdiction that does have policy regulation in place, and we're first to kind of launch in terms of climate-related disclosures. Be interesting to get your thoughts on the greenwashing aspects within the New Zealand landscape. Do you see it as being an issue that asset managers locally are more concerned about greenwashing? And I guess secondly, do you see that the current legislation and the regulation is as clear as it needs to be so that people know what is expected of them?
Yeah, I mean, I think greenwashing is a big issue here because we don't have a huge amount of regulatory guidance. I mean, it's important that we should be concerned about greenwashing. Our industry is in a really important phase of maturation, and we have quite low penetration of AUM in responsible investing labelled strategies. So we have this massive opportunity to really get it right. And a concern about greenwashing is a really important part of that. We need to all be making sure that we can demonstrably back up our claims and say show that we are doing what we say we do in order to legitimize this industry. And if we're not doing that, then we're doing all of us and the impact that we're trying to achieve a disservice. But I do think it's driving green hushing in New Zealand because we just don't have clear guidance. We don't have a labelling regime. We don't have a taxonomy to tell us what green investments are and what they aren't. We don't even have kind of clear guardrails from our regulator on what they consider responsible investing to be. So I think there's a lot of room for more clear guidance from the FMA, and hopefully that's all a work in progress.
Yeah, and I should point out to those, in case you're not aware, the government has announced as part of a broader sustainable finance strategy, the work on a taxonomy that work's underway in Australia as well, and is sort of well advanced now. Maybe just thinking about that Australian experience, and obviously RIAA covers both markets. In Australia, we've seen ASIC be quite punitive with some asset managers. And one of the things we've seen is a real increase in the shift from claims and the substantiation of them, in a lot of instances, moving out of the marketing team and into the legal team, is, in spite of the fact that we haven't kind of seen as much of that kind of activity in New Zealand from a punitive perspective. Does that resonate with you, Francis, like working in the industry? Like, are asset managers looking at that and being concerned about it and worrying that that's something they might need to be thinking about in the near future?
Absolutely. And I wonder if that's linked to that drop that you saw in the survey of asset managers that are excluding fossil fuels, because the practicalities, particularly if you have an ETFs or any form of passive investing, and particularly in bond funds, as Erica will know, to be able to ensure that you are absolutely 100% perfect at excluding every tiny exposure when you may have hundreds, if not thousands, is really, really, really difficult. And so it doesn't feel like we're being very realistic about our expectation on investment managers or what investment managers are able to achieve. So it's definitely front of mind for New Zealand managers, and we're using Australia as a benchmark. Hopefully the great thing about that is it's making us all a lot more careful, uplifting all our processes, uplifting all our controls, all our risk management, and making sure that we're doing a better job.
And we've already, it was never going to be an investment conversation without climate-related disclosures coming up. We've already touched on it very briefly. That regime has had a significant impact on the type of work that's happened in New Zealand, right? Would be really keen to get your thoughts initially, Francis, on you've been on the front line of that. You've obviously been working with others who are also doing the same things. What have we learned by going through that process?
Great question. And I want to start actually by saying congratulations for everyone that participated and delivered a mandatory climate disclosure and report, because, man, it was a huge amount of work. And as one of the first mandatory disclosure regimes in the world, I think there's a huge amount to be proud of having achieved that. So congratulations to everyone. I think we're all still reeling from it a little bit. But as I get the opportunity to stand back and reflect on what that did help us learn, I mean, for me individually, I feel a lot more clear about my strategy, what is purely risk management and what is more value-based, and how we execute those two parts of the strategy perhaps differently. I think that's really important. I did also become a lot clearer on actually how much climate risk we do have in our funds through all those different metrics that we analysed, some of which we hadn't looked at before. So I think that is a great opportunity for us to be able to manage that climate risk better. But for me, the main takeaway wasn't so much what we learned, it's actually what our governance bodies learned. And going through all that training, understanding a lot more about climate risk, understanding those metrics, having to clearly differentiate their strategy, perhaps set targets, put remuneration in place. I think that's accelerated years worth of work. And hopefully that will really continue to push climate investing in New Zealand and what we're doing in Australasia as well. Because getting those governance bodies up to speed, has been a real achievement.
Erica, be keen to get your thoughts. You've been in a very different position where I know you've had a number of customers coming to you looking for data and asking questions. Be interested to get your insight into how that's gone and what kind of advice you might have for the asset managers who are operating in New Zealand in this landscape.
Yeah, so as a global manager, you're right, we're working with clients across different regions and therefore different regulatory regimes. This can be an advantage because there's a depth of experience that we have in working with clients to meet their reporting needs, but this also presents challenges in that the requirements, will vary across regions and as well among clients. So, there's an additional layer here as well that not all managers may be providing the same output, which creates complexity on the client or the asset owners, plate in terms of then transposing, the information that they're getting, the data that they're getting into the regulatory format for compliance. So, all of this is to say it's quite a complex picture, but I think that there's an important outcome in sight. So, the perception that maybe reporting, currently is presenting limited value to some investors at this time may be fair, but I think that that's just because reporting right now is in its infancy. And the industry, all of the stakeholders involved, as we just talked about, are trying to figure out how to reconcile, to get the data in the format that is, the most usable ultimately for, the reporting back to the regulator. And so, I think that there over time will be a shift as we kind of mature in the regulatory reporting phase from infancy into more developed. That's going to take time, but I think the outcome is that the reporting will become more useful over time as entities go through the reporting on quantitative impacts, their transition plans, and ultimately getting into a more scalable output. But it will take time.
And obviously, again, we talked about the fact you're operating in a lot of different global markets, a lot of different regulation. One of the things we've seen this year is a lot of regulation, either starting, landing, some regulation changing, and also a lot of political upheaval. I think somebody said half of the world's population in 2024 went to the polls. Very conscious that's perhaps nowhere truer than in the US where you're based, Erica. Would be great to maybe get your views on what you think this change period is actually going to mean and how you think, obviously understanding that, there's a lot of unknowns at this point, how is it going to actually change the impact? How will it impact the investment landscape in the US in the next year or two, do you think?
Yeah, so I think there are kind of two potential impacts, one from more of a policy and a regulatory perspective, and the other from an investment perspective, and some of that will actually be intertwined. But as you mentioned, Dean, there's a lot still to be seen in terms of what will materialize under the incoming administration. But based on what has been said thus far, I think it's fair to expect that there will be less regulation. In terms of the U.S. securities regulation, it's expected that the SEC is unlikely to focus as much on ESG as it did under the current administration. We've talked a lot about climate disclosures. So unlikely that mandatory disclosure around climate is going to materialize going forward. So it will be more incumbent on the market players to voluntarily disclose, and I think again this is where engagement comes into play around encouraging transparency around disclosure and activities to the market and to investors broadly. Now, from an investment perspective, again, we'll see how policy and other financial incentives evolve. But, with that aside, there are, what we perceive to be structural tailwinds and long-term trends that are already in motion that will continue to support certain markets and opportunities in the space. Think of things like AI and data centers, the development and the storage and the energy consumption, around, that technology that's expected to grow going forward. So, we look to kind of those sorts of trends, as well as lower carbon alternatives to meet globally increasing power demand alongside transition. Again, this is the theme that has been in play, and that we continue to think will have relevance and durability looking forward from an investing perspective.
Francis, might go back to you. One of the other kind of really interesting findings was around the growth in transparency and reporting. And we've obviously seen a big growth in particular in stewardship reporting. It comes off the back of the New Zealand Stewardship Code, which we launched a couple of years ago. There's obviously lots of momentum around that strategy. You're a founding signatory of the code. Be keen to get your feedback on how you have seen it impact.
We've loved being part of the code. I think it's such a fantastic development for New Zealand. It enables us all to have some great frameworks to actually determine how to report our stewardship and what kind of stewardship activities we should be doing. So that kind of sharing of best practice and how to undertake stewardship effectively and report it, I think it's been the kind of the starting point and where we all got to quite quickly, and an early focus of the code. Now we're moving on to start to work together to try and have more impact. And I think we've got a huge opportunity in New Zealand. We're relatively small. We're quite a concentrated market, and the Stewardship Code has a really high number of signatories. It covers a large proportion of the New Zealand investment community. So we have a massive opportunity here to actually try and get together and make some change to our stewardship for our stewardship activities, and actually take some leadership in New Zealand. So I think it's had some impact to start, but all of that impact is only going to grow from here.
And you mentioned obviously the reporting is a great sort of framework and place to start. One of the things we've seen also come in recent years, I think, is particularly in the last probably 12 to 18 months, a little bit of a pushback again on this concept of stewardship. And, there are in a landscape where, we're still seeing fossil fuel providers making record profits. And, there's been large-scale organisations in New Zealand. Think Air New Zealand is a good example, totally walking back, what were very bold, aspirational, very popular and highly marketed claims about where they were going with net zero. Do you think that stewardship is still a really legitimate and positive engagement, positive investment strategy? And can we really kind of, is it something we can hang our hat on, or do you think it's fair for people to start questioning the actual outcomes rather than just the report?
Yeah, we should absolutely be questioning the outcomes. I think, though, in New Zealand, we're a lot of small investors, and this is almost an existential problem for us, not only for our stewardship activities, but also for our exclusion activities too. I mean, there aren't many big companies that care if a very small investor excludes them, and it's equally difficult to try and claim direct and singularly effective change from being a small manager excluding a company as it is from being a small manager trying to engage with a company. So we need to be more realistic about how we have impact as an industry. Unfortunately, as you point out, we haven't yet changed the world, despite responsible investment strategies been around now for multi-decades. So we need to mature, we need to evolve. And I think that involves a lot more of working together. So we need more investment managers to actually have responsible investment strategies. Then we can really, really build this snowball. And stewardship allows, it's just another strategy, another tool in the toolbox for responsible managers to use, particularly if exclusion isn't going to be wide, or they're not able to widely exclude within their investment strategies. So they're complementary in that regard. They should be used to work together. But I do think stewardship is only really just starting. It really is quite new. It really is maturing, and we're only really pushing this concept of working together, pooling our influence. And this is how you get small investors really being able to make change. And we're seeing a little bit of that with Climate Action 100+ and how that's working in Australia. We recently got Santos to set some Scope 3 targets, which is, a fantastic outcome. So there is a lot of reporting. There is a big reporting burden, but off the back of that, hopefully we can get these activities going and have a real crack at making some change.
I'll come back to that reporting burden in a sec, but Erica, would love to get your thoughts as a big, owner of assets across the globe. How do you see the stewardship conversation advancing and developing at the moment?
Yeah, so likewise, we share the view that stewardship is an important component to a sustainable strategy, and the impact and the outcomes related to stewardship, and from our perspective, engagement, I think is really the next phase. And it's in some ways integrated as part of the way that we also view the integration of ESG risk factors in our assessment and our evaluation. But similarly, ESG is integrated in terms of our engagement. So alongside having conversations around board composition or improving operational efficiency, we may also be engaging on material climate risks or enhancing worker safety and training. So again, it's a measure and as Francis put it, another tool that we have in our toolkit to integrate ESG into a process, and where it is material to a company, to really encourage an outcome that should benefit the investor and ultimately the portfolios that we're managing. Now, we also have an additional kind of lever in our engagement to engage with issuers who are interested in coming to market with project financing specifically earmarked to environmental projects or social projects. So what I'm talking about are, ESG labeled bond issuances. This is an increasing growing area of the market that fixed income investors, can invest in. Currently issuance of ESG labeled bonds stands at roughly $5 trillion, and it's growing. So issuance, this year to date has been, around $800 billion. Across different sectors and across different issuer types. So it's a diverse market. And again, these financing mechanisms really allow borrowers to, put their financing, to work to meet a certain environmental or climate commitment. And, we think that this is really a tool that can have that impact that responsible and sustainable investors are really looking for in the next stage in the evolution of ESG investing.
I'm going to ask about reporting burden in a sec, but just we've had a question come in around the impact funds and whether they're investing in global equities as opposed to trans-Tasman. Just an update on that. So we don't specifically ask the destination of the assets. Just to unpack that a little bit, though, what we do ask is what is the name of the funds and what is the intent or the area of impact that it is focused on. One thing, again, just so everyone's aware, in terms of one really interesting trend that we've seen play out in this regard is that as well as seeing some, really strong what are local funds that are investing in particular climate-specific elements, but also others outside of that. What we've also seen this year for the first time is that there was a broader range of asset managers who carved out a very small percentage of a broader non-impact fund and highlighted that as being funds that were intentionally targeting impact outcomes. And so that's a very different shift for us because, again, these are asset managers who, when we've asked this question historically, they've simply said that we don't look at impact at all, or there's no impact money being allocated as a part of our portfolio. Whereas now we're starting to see just a little bit of money, impact money, working its way not into impact labeled funds, but into broader portfolios, which is quite an interesting development. Sorry for the sidetrack, Erica and Francis, but that one just came in by Q&A. We talked about reporting burden. Francis, I'm going to start with you because, again, you've been doing climate-related disclosures. I think we've seen lots of positivity, but also a lot of fatigue from just the sheer amount of work and the volume that's come as a part of that. Climate-related disclosures are not the only form of reporting that have come in. They're not the only form of voluntary, let alone mandatory reporting that's come in. Do you think it's as valuable and it's proving as valuable as we'd hoped for? And I guess I'm keen from both of you, I'd love to unpack a little bit about, are we sacrificing outcomes for the sake of getting great reporting? And are we, there are organizations who I've spoken to who have said we would have achieved more by not doing this report and taking all of the resources that we put into the disclosures and actually putting them into outcomes. And in fact, in some instances, they've highlighted that they've taken people off delivering outcomes so that they can produce the report. Obviously, some of that's inevitable, but would really be keen to get, Francis, you first, your insight into how that trade-off goes, and do you think we've got it right at the moment?
That's a big loaded question, Dean, but the right one to be asking, because it was a huge amount of work. And I think I've also heard people complaining that no one even reads them, right? So from that perspective, when we're small managers, it's frustrating. But I think we need to take a step back. And I would love to say that my ducks were so tightly in a row that I didn't need to do any work to produce this reporting. And so I took people off all these fantastic things that we were doing in order to spend days, weeks of work on producing a glossy document that just reflected what was already being done. But that is not true. And also, I think producing the nice glossy document, if we had all of our ducks in a row like that, wouldn't have actually been a huge amount of work. The work was putting in the bottom of the iceberg. And Helen Skinner from ANZ talked about this really well, that the report is only showing the top tiny little bit of the iceberg. All the work that was done was the work that was done underneath on getting our strategy right, getting our processes right, delivering all of those new metrics to understand climate risk across the fund, putting in governance structures, putting in reporting frameworks, and potentially REM and targets, as I talked about before. I don't understand how that can ever be a bad thing, even though having to do all of that in 1 year was huge. As I said previously, it just accelerated an enormous amount of work. And I think is providing a much stronger platform for us to go and deliver that impact from. So for me, I don't actually care if no one reads our report. The benefit was doing all of that work, having all of that now in place, and having all of that eyes from my governance committee and all of that understanding and reporting now there ready so that we can do a much better job. So I think, unfortunately, it's necessary because we don't have those clear guardrails from our regulator. But now we have a reporting regime that really tells us what we should be doing and what good looks like. So from that perspective, it's just a necessary part of getting better, maturing as an industry, and it should get easier as now we just bed in. The first year is always the hardest, so now we've got that platform built, we can just do a much easier job on the reporting and focus back on using that platform to create our impact, and hopefully it will allow us to create more impact as we go forward. I also just want to quickly say, because I use climate statements too when I put my investor hat on, we've got a full team here and a full person New Zealand team actually using these climate statements. And there's some great information in there. Transition plans in particular, we talked a lot about climate risk. We're now getting a statement, or we will get, we've got it from some, but we will get it as it rolls mandatory this next year as part of the climate reporting. We're going to get these transition plans that tell us how every business in New Zealand is planning to transition their business. I mean, that is nothing but fantastic as an investor and helping us understand climate risk and allocate money more effectively. So I think it's great, personally.
Erica, be keen again for you to weigh in on this, again, with different types of reporting regimes in different areas, and again, a huge amount of voluntary stuff. I know, the PRI are looking at all their reporting, even the benchmark reporting that we ask people to do is in no way, a small task. How do you see it playing out going forward? And do you think we've got the balance right in terms of reports versus outcomes?
Yeah, well, I think, from our perspective, and, putting on our fiduciary hat, we owe it to, our clients to be transparent about, what we're doing, and to be vigilant also about how we're communicating that externally. So, in some ways, the reporting that we're putting out, if it's not a part of mandatory reporting and it is voluntary, it's a way of kind of crystallizing and documenting really the practices that are already occurring, and just making sure that those are communicated, clearly and transparently to our clients, which will help them, understand, what we're doing for their portfolios. But we talked about ESG integration before and how increasingly this is becoming, a really important topic for investors globally, and a part of the due diligence that they have for the asset managers that they work with. And so in some ways, our ability to kind of put together these reports to show the progress that we've made year over year or period over period really helps them to, underwrite what their managers and what PIMCO is in particularly doing from an ESG perspective, whether that's from an integration perspective or whether that's in support of a sustainability portfolio that we may manage for them. So, I think again, it's about, us, supporting our clients, and making sure that, we're being transparent, and we are accountable for, doing what we're saying we're doing and making sure that that's updated, as we continue to evolve our practices as well internally.
Talked about impacts just before and some of the findings here, which I'd really love to just dive into a little bit, because I think while we've seen at one end, what is now a real proliferation where effectively all of the people who are now responding to our surveys are saying we're basically using integration, negative screening, and stewardship as an overlay to just about all the investments we're making. And while that's great, I guess there's the outcomes piece that we've just been talking about is really delivered by positive investment and investing intentionally for positive outcomes. I highlighted that trend just before about actually, rather than it just being about pure play impact funds, for want of a better word, and certainly those are the labels that have been used, but now seeing impact allocations making their way into mainstream portfolios, and being a part of an investment strategy that's not just targeting outcomes, but also targeting broader returns, risk assessments, all those kind of things. One, be interested to see, and Erica, maybe start with you. Does this reflect what you've seen in the market? And is this something that we think is going to be able to scale a little more going forward so we can get more capital going into more positive outcomes?
Yeah, so the report findings on this is something that we are seeing kind of reflected in our global client base. However, it is evolving at different speeds in different markets, as you can appreciate. But I think the takeaway is that broadly, investors are expanding their view of ESG investing. The terminology is changing globally, and it's shifting a bit away from what most would view as traditional ESG or exclusionary investing to more inclusionary approaches, where there is even more of a willingness to, let's say, invest in sectors that are in transition, that are in harder to abate, or manufacturing or other sectors that would normally be a part of an exclusionary approach. And so that is shifting, but again at different speeds in different markets. Now the other thing is that when we talk about transition, it is largely undefined, and so investors can also really self-select and find the objectives that are going to align with what they perceive to be the greatest risks or opportunities that they want to address when they're looking to direct capital to support, what they would view as a sustainable activity, or, a business or a sector that is in transition, that will ultimately benefit. And we have seen this, from a client perspective in many different approaches. We've seen it in terms of, having a broader kind of objective toward climate transition investing, or having more of a focus on biodiversity or natural capital as a consideration in an ESG approach. And we've also seen, for some clients that have, more, climate-oriented or net zero commitments to meet specific carbon reduction targets in their portfolio. So I think the takeaway is that there are, really a variety of different approaches that clients are taking. But I think the undercurrent of it is that, again, the terminology and really the nomenclature that we've been using is really kind of shifting, and there's maybe a broadening out of what a perceived opportunity set could look like.
Francis, you're at Milford, managing lots of different types of funds, and I guess again, keen to get your thoughts on this as an emerging trend in the impact space, or in impact allocations at the very least. Do you think it's likely that we'll see a growth in impact funds specifically, or is it going to be that there will be impact allocations sitting within a growth fund as part of a normal investment strategy?
I hope both, because this is really exciting. As you said at the start, this is what we need to be doing, putting capital to where it matters. And unfortunately, when you've got more of an exclusion strategy, which is obviously a little bit easier to execute, if you are excluding fossil fuels and rebalancing, say into a global portfolio, not a lot of that capital is finding its way to where it needs to be. It's often just finding its way through that rebalancing process into more big tech. So it might be helping you avoid climate risk and avoid harm, but it isn't necessarily getting that capital to where it needs to be. So hopefully we get both. I actually think in New Zealand there's a lot more of that impact investing within broader strategies than we're reporting, because we don't, to Erica's point, it's all very self-defined, and we often don't have the capability all the time to be able to make that definition, ring fence it and report it, or the confidence to do it when, you mentioned the New Zealand taxonomy that's under development. I'm really excited about that because that will give us the confidence to actually feel like we're able to label what is impact rather than what is just a really, really good investment with climate tailwinds. So I think there's more of this going on than we realise. And I think the more we're able to identify it, the more it will give us confidence to do more of it as well. So hopefully it's a self-fulfilling prophecy as we develop and mature in this area. It's very difficult in listed to develop impact strategies and actually label them as impact strategies, particularly without a clear labeling regime. So in the current climate, I would suggest it's probably more of that. More that's going to happen, it will happen within broader strategies rather than specific impact portfolios, but let's hope for both.
You mentioned concern about, like in lieu of a taxonomy, the concern about making a claim. Does that I guess flow through to customers as well? Like, is there apprehension about telling a customer that we're investing in impact because of a perceived negativity from a customer, or is that not really as relevant?
Good question. I mean, not necessarily. I think there are those customers out there that want impact, and I think that's what most people actually want. When you drill down and do some surveys about what customers actually are looking for, it's they want to do good with their money. So I don't think it's so much a customer demand concern. It's more we have self-defined what this impact is, and we don't want to get that wrong.
Okay, good to know. Coming and very conscious of time, we're coming close to a close. A lot of this has been very retrospective looking, and obviously data like this is designed to tell us what has happened rather than what's going to happen next. Would be keen, particularly on Erica, from you, looking externally. You mentioned what's happened in the US on the back of a change in election. Do you see any particular policy shifts or regulatory shifts that in New Zealand we should be looking at and maybe we aren't? And I think I guess where that question comes from is one of the challenges with being here is that we are on the other side of the world, a long way away, and it is and we can get very focused on what is massively in front of us, and particularly when you've got things like climate related disclosures coming down the pipeline that you must do a job of. What exists externally that we should be looking at that you fear we might not be, or that you want to make sure that we are?
Yeah, well, I mean, with the benefit of hindsight, I think that in your market, you can be watching the global regulatory requirements evolve and really learn from that. And I think you can partner with a global manager who is also helping, global clients navigate that. But I think it's taking on a mentality that this is going to be an iterative approach. It is likely going to, come with having a mindset to collaborate, with your managers, but also your regulators and your peers in the industry to kind of get through the evolving kind of nature of new regulations and be measured that it's going to be potentially messy and uncomfortable before it gets to be more streamlined and more scalable. So I think that in some ways it's good that the regulatory regime is is maybe, still evolving and still nascent, because you can learn from, what others have done. But, on the flip side, you still have maybe a bit more pain ahead. And so I think that taking, again, kind of that measured and that iterative, approach will be helpful in just navigating some of that.
Wonderful, thank you. Again, I'm just going to jump to a question before I come back to you both, because it's specifically looking at the survey and some of the methodology. So someone's quite rightly pointed out fossil fuel exclusion is one where we did see a big drop from 96 down to 44% in 1 year. We did, obviously, with a big drop like that, have a look into it. One of the things, and it really does highlight, I guess, one of the challenges of a methodology of a report like this, is that it's important to understand that with all of the breakdowns, and when we're breaking down specific themes and types, and all of those are self-defined. And so I think it does come back a little bit to Francis's comment before, which is to get to an outcome like this, we have asked each of the asset managers, again, what percentage of your portfolio are you completely excluding fossil fuels from? What we've started to see is, and certainly what we've seen this year, is that last year, people who absolutely had a blanket ban on fossil fuels no longer do. That doesn't mean that they've suddenly gone out and started investing in a whole lot of gas exploration or mining opportunities. It simply means that people are starting to become potentially a bit clearer around exactly what they mean when they talk about exclusions. So there's not, again, based on sort of diving into those results, there's not a wild swing that we've seen that is concerning, but definitely one that is interesting to kind of note. Again, moving on to sort of final questions. Trends-wise, we covered a lot of great stuff around growth. We've looked at the impact investing piece in particular, the rise of greenwash, which I don't think is, as a concern, which I don't think will surprise anybody, but is significant to quantify in terms of just how much of a deterrent it's causing. In terms of, again, getting that crystal ball out, trends that are coming up, what do you think is going to happen next? Francis, I might start with you. What do you think 2025 is going to hold for us in terms of, as an industry, taking on board all the things that, one, we've seen that have been quantified in the report, but two, everything else that's going on in the world? Throw us out some predictions on what the big trends are going to be. We'll come back next year and hold you to them.
Oh, good question. I think in New Zealand, we're really good at getting on with doing the doing. So I think for us, taking more of a domestic focus in New Zealand, we're going to be really focused on growing our stewardship and our collaborative stewardship through the Stewardship Code. And we've got a couple of collaborative engagements that the IDCC and the Stewardship Code are looking at potentially kicking off in more of a formalised way. So I hope we're going to see some fantastic collaborative engagements in New Zealand and getting some outcomes. And on the second part, I do think it comes back to that impact investing and identifying those climate-related opportunities. I think we're going to see more money towards those sectors that need it and that capital that matters. So we may not report it, but I think that's going to definitely be what we will see happening.
Wonderful. Erica, what about you?
Yeah, so, I think that from what we're seeing, clients broadly are really still focused on, environmental concerns, considerations, and climate-related risks. So, from our standpoint, we will continue to focus on those themes from an integration perspective, right? So how we consider physical and transition risks into our investment process at large, but also how we would integrate, the climate-related considerations in the individual issuer evaluation and assessments, and how those may impact a borrower's credit rating, from an ESG evaluation standpoint. Now, we'll also continue to, focus our efforts in engagement. And so this may include, climate considerations around, mitigation, transparency of disclosures, as well as labeled debt issuance, which we've talked about. And then finally, in the products that we offer clients and the servicing capabilities that we have available to support clients to meet their reporting and their regulatory, objectives. We think that this is all going to be really important as we look ahead. So it's having, I think an integrated but also a cohesive approach that, consists of a lot of different ways to help, investors meet their obligations. Again, whether that's a traditional portfolio, a portfolio that has more of an impact or sustainable investment objective, and then of course on the reporting side of it. So I think that that's maybe one. And then, this idea around, impact, and so, producing reporting around the outcomes and the impacts that a portfolio may have, or around the engagement and stewardship activities, that will also be important. And then I think more from maybe a thematic perspective is this idea around, supporting the transition, and kind of what that means in terms of a real world impact for sustainable investing. And so that might mean, providing, financing for sovereigns or for countries that are upgrading their infrastructure for their energy sources and energy capacity. But that also may mean, for companies that are in transition. So, producing more renewable sources of energy capacity to the grid, and kind of, reducing the dependence on coal or other higher emitting, parts of the energy sector. And so, I think that there are opportunities, across a transition spectrum, that, will help, both, the borrowers of this capital meet their commitments, but also from an investor's perspective, meet their sustainable objectives or their, external commitments, or other decarbonization goals that they have from a portfolio perspective. So it's a rather integrated, a process, but I think it really will be, focused a lot on kind of these climate related issues and environmental and transition themes going forward.
Wonderful. And I feel a little bit bad now that I've stitched you both up with making some predictions. And so I feel like I should probably throw out my own one, which is, I think looking at 2024, what's happened is we've really seen some of the building blocks that we needed for the mahi-tahi, the collaboration, to really, really launch in 2025. The Aotearoa Collaborative Working Group, which was only just getting off the ground this time last year, has developed a huge amount of momentum. There is, for those of you who are members, if you haven't been involved in that yet, we've got a meeting in Wellington happening on Thursday, and you're able to dial into that virtually. Let us know if you haven't engaged with that yet. Obviously, the Stewardship Code, which you mentioned already, Francis. I was last night at Impact Investing New Zealand's celebration, and as we announced at the conference earlier in the year, we're now working on how we can integrate impact investing as a program within RIAA's wider work stream. All of those things really have come about in the last couple of years, and have all been driven by this massive enthusiasm from people within the industry to get together and collaborate and work hard to deliver some outcomes. And I think it's been a lot of work getting some of that infrastructure built and set up. But I think we really do have the opportunity now that platform is there to launch. And so very much looking forward to next year and seeing the outcomes of a lot of that work starting to deliver and starting to come through. And so apologies, now we're coming close to time. A couple of things. We've obviously, thank you to everybody who threw the questions in. Really just left for me to say, an absolutely massive ngā mihi nui kia koutou to Erica, to Francis for lending us their expertise this morning, to all of you who put in questions, in particular to the teams at EY and to PIMCO for all their support, and obviously to the entire RIAA team who does a massive amount of lifting to bring a report like this together. We start asking these questions in March. We put the survey together in January, and it's now the 3rd of December, and we're delivering the report. Like it does take a massive amount of work. So huge thank you to all of those who have contributed, and of course to the RIAA members who are the people who allow us to do this mahi. You support us with the funds that you provide, but also with the expertise and by giving up your time to to supply your data. A quick final one from me. We've launched the Australian conference next year, which you can tune into. Come if you ever are interested in what's happening in Australia. The RIAA conference is the largest by distance in terms of bringing all of the responsible investment people together. I highly encourage you to take a look at it. it's a great opportunity to come and learn and just broaden the scope. A large number of Kiwis came over this year, got a lot out of it. And if you know somebody who's come, again, ask them the question, because all of the Kiwis I've talked to get a massive amount of value out of it. We've got super early bird registrations, which are closing on the 23rd of December, just in time for Christmas. And so highly encourage you to get into that. Otherwise, for those of you who I won't see again, have a wonderful break. I know there's lots of activity. There's Stewardship Code events tomorrow. There's, as I say, the Collaborative Working Group. Otherwise, sorry, maybe shouldn't have bitten that one off. The Statement Day and ka kite.